Yeah, honestly, my when I look back and I think, how did I get into all this? Um, I think back to something my dad said to me when I was in college that was actually pretty terrifying. It wasn't meant to be, but um, I was very type A in college. I was always looking to find the next internship, find the next opportunity, set myself up um, to get the job and then move up in the job. And I remember my dad saying to me, well, you really should enjoy your summers because once you start working, you're probably not going to stop. You're going to work for 30, 35 years. That had been his experience. Um, and to me, that was absolutely terrifying to just do something for 30 years. I know some people, they find their calling, they're happy with that. And it wasn't me. So when I got my first job, I joined a startup. I um, joined a company called Blink. We made smart home cameras, and it was exactly what I wanted to be doing. This team of about 25 people. I was the first mechanical engineer hired at the company. Pretty much my dream job, like all things considered. Uh, but when I got to that job on the first day, I walk in, I meet everybody, love my team. I'm doing exciting work. I just remember going in and seeing my desk area. It's a 7x7 cubicle, and it's a little cliche, but to me, that just represented kind of like the bounds that were upon me in this job. And uh, that I was working for somebody. I had to be there for a certain amount of time per day. The work had to get done, and I had to do it, and I really didn't have a lot of freedom outside of that, right? And I just knew from basically day one that I wanted to go out and build something of my own. So I kept that job for a really long time, but all the while I went home, started researching online how people were building wealth, what other people were doing, and of course, one of the first things that came up was real estate, right? So everybody knows that, everybody's heard of somebody, whether it's on Instagram or a friend or whatnot, who quits their job, goes into real estate, starts making a bunch of money, and it seemed to me like it could be a big wealth builder that could accelerate my journey towards financial freedom and owning my own business. And pretty soon I became just totally obsessed with everything real estate investing, um, and spent the next 3 years learning essentially. So would wake up, read something about real estate, whether it was a book, whether it was an article, jump in my car, hit a podcast on the way to work. When I was leaving work, do the same thing and repeat, and basically until I went to bed. And I did that for 3 years, and all the while I was also trying to buy real estate myself, um, but really wasn't having any success. And the reason for that, looking back, was one, I was just unfocused. I was looking at a lot of different markets, at a lot of different strategies. I would hone in on something like long-term rentals in, one marketplace, and then I would go on Instagram and see somebody killing it in short-term rentals, and I would take my focus and shift it over there and go off in that direction. And it just led to a lack of progress. I was also unnetworked. I didn't know anybody in the business, and frankly, even though I was new to it, I was kind of embarrassed that I didn't know much. So I was hesitant to go out, put myself out there and meet other folks in real estate. Um, but as a consequence, I wasn't making any progress because real estate is such a network heavy industry. Like, it really matters who you know. Um, and then I was also afraid to make mistakes. I would look at the amount of debt I would have to go into to buy a property, and I was afraid by, the hundreds of thousands of dollars that it took to get into the game. At being an engineer, I was quite conservative from the jump. So I was just afraid to make a wrong move. And I continued in this cycle until one day was walking down the street in Boston where I lived, and it was Saturday night. So just walking home from a friend's house, and I happened upon a wallet that I found in the street. Um, and I picked it up, trying to see whose it was so I could return it to them, and found out just through the internet and Instagram when I looked the person up that they were running a real estate business. And they were about the same age as me. While I had gone off and got this job at Blink and started to climb the corporate ladder, this person had, I guess, in their junior year, they'd started buying properties, just scratching and clawing to get deals done, find financing, recycle that capital. And by the time I had met them, they were about 60 units in, and they had documented the whole thing on Instagram. So all the successes, all the failures was all there for me to see. And I spent a good 2 hours that night looking through everything. And after doing that, I thought to myself, well, one, I would really like to meet this person, and I'd honestly like to be this person. You know, they're doing exactly what I want to do. But um, how can I bring them any value, considering that I didn't have a great network in real estate? I didn't have a ton of experience at the time. Um, and what occurred to me was really the only way I could add value to them was to invest some cash in what they were doing. And this is before I knew anything about funds or syndications. But I figured, you know, this person might benefit from me writing them a check and partnering. And that's what I did. I approached them. I said, hey, well, for one, I got your wallet and I'd like to give it back to you. And then when I met up with them, said, hey, if you're ever looking to do a deal with somebody, I'd love to invest some cash alongside you and we can partner. And turns out I was right. He was looking for that, and that was my first joint venture deal. So after that, you know, started to pick up a little bit of momentum. Did my first direct investment, we can call it. Bought a new construction single family home down in Florida, and ended up flipping that, and did my first JV deal with that individual, the wallet guy. That was down in Florida as well, small 16 unit. And that was my first intro into passive investing. Then I went the house hack route, you know, started buying small multifamily in my market where I was living in one side, renting the other side out. And I also got my real estate sales license. So, you know, started selling houses as a realtor. This is the first one I ever sold. That was actually my grandpa's house, and sold about 5 houses doing that, which and all these different things. I was really just trying to get a grasp on real estate as a whole. So one, the sales side, what was that like? You know, house hacking, what's it like to manage properties and deal with tenants? Passive investing, what's it like to be an LP? You know, and do some of these deals that are more heavy on like the private equity side, and then you know, the out of state flipping, new construction stuff with the first one. And I really honed in on syndications and funds as being a strategy that was most beneficial to me. And that's because I was still working a lot. You know, I was in a pretty high stress role, working on the engineering team. I was still not living in a market that made sense to go buy properties. You know, I had the house hack, but it didn't really make sense to scale up beyond that. Um, and I saw that instead I can go take my cash and meet other operators, invest with them, and diversify in that way. So, you know, ended up investing in about a dozen different syndications and funds as an LP. And all the while I was thinking, well, you know, I want to build a business. How can I do that? And listened to a podcast one day that said the best way to build a business is to help the person you used to be. And for me, that was the tech employee that was looking to invest into real estate, wasn't really sure how to, had a busy job, you know, maybe had a family, really didn't have the time to go and build their own business, you know, doing real estate. And I figured I could relate to that person because that's who I used to be. And that's when I got a little bit behind on my slides, but that's when I decided to start my business, Burns Capital Partners, which started in early 2022. Focuses mostly on multifamily and private credit, which is essentially the lending side of real estate. To date, I've done 7 offerings. I've raised a little bit over 6 million in investor capital, and work mostly with people from my background, so think like senior software engineers that work at big tech companies. Um, and have done that all while over the last 2.5 years, still working at Amazon. So maybe relatable for some of you guys, and for a lot of my investors who are juggling multiple things. And in doing that, shipping 5 products, me being the on the mechanical side, so all things related to product design, and watching as the company went from having shipped about 250,000 devices when I started to over 40 million devices by the time I left, seeing these things that I built on, or I should say things I designed on, Home Depot and houses as I walked down the street, and then picking up a bunch of design patents along the way, which all sounds great, but still all the while struggling with big questions like when to leave my job, which I had totally fallen out of love with and was burnt out, and balancing that with the delayed gratification of building a private equity company, or an investment company where the money I raise, my investors get paid first, basically, and I get paid last. So if I do good deals, I could build a great business, but if I don't, wouldn't have much of a business at all, and um, took me a long time to realize that what I was chasing was wrong. It was kind of just chasing money, number, just trying to get to a point where I could say, hey, as long as if I get to this number, then X, then I'll leave my job, or then I'll have enough money to start this business. And came to the realization that that's just it's a fallacy. It's a moving goalpost that people chase forever and they never hit. And for me, the more important things were doing things that I found valuable, that had purpose, that gave me opportunities to grow, which I feel like I'd hit my ceiling at Amazon, and allowed me the time freedom to work on things that matter to me, and then also spend a lot of time with my family. So, only about 2 weeks ago, so pretty fresh, I quit my job at Amazon. Um, walked away from a very stable job where I probably could have stayed on. I was working from home for the last couple of years. But I felt like it was time for me to go full time into my business. And now my current focus is, growing our AUM, but the 20 million is honestly, it's just a nice number, nice round number. It's a little arbitrary. My real focus is just doing good deals with good people, and scaling up our business operationally. So, Brendan, who's on the call, him and I just kind of are working on a lot of automations and tweaks and figuring out where our business has leaks, and repairing those, and hopefully that making us a little bit more efficient. So uh, that brings me up to today, and would love to take the conversation any which way from there. Like Mike said, I got a couple different deals going on right now, both on the private credit side. Looks like we're having a multifamily offering coming up pretty soon with the wallet person, as a matter of fact, who I've done a number of deals with, and yeah, this is my contact info on there in case anybody wants to take it down.
Love the story, TJ, and appreciate you sharing. I certainly can relate with a portion of your story. I think one thing that would be really interesting for you to maybe do a quick like Spark Notes TLDR is, and just for the group, I recently invested with TJ on a private credit fund, within, I think it's titled Spectra is what we titled it. Would love for you to maybe just do a run through of like, what's the value proposition of private credit? How does that differ from, a multifamily syndication? Why are you interested in the private credit world? And maybe just touching on like a few of the reasons why folks in this room who may have some extra cash lying around may want to look into the private credit world versus, your traditional syndicate or buying their own real estate.
Yeah, great question. So first off, like, what is private credit? It's just a fancy term for lending. So what we're doing is we're raising money and we're providing debt capital to other real estate investors. So you think about, a house that you buy, you probably get a mortgage typically. What we're doing is we're providing the financing for that mortgage, but we're doing so for commercial borrowers or investors. So why one, like, right now the macro landscape for private credit is advantageous. We just went through a period of basically 0% interest for a number of years. Um, that affects the rates that you get, the yield that you get as a lender. So we went from low yield to relatively high yield. While that was happening, as these rates went up, the banking system got incredibly stressed and still is pretty stressed, to the point where a lot of traditional lenders aren't making loans. Like, you think about your regional banks, um, they have these existing loans on their books, and they're saying we have enough exposure to real estate. We're not going to make any new loans. And what that's doing is it's creating a vacuum for new providers of debt capital to enter and to dictate terms, right? So you take those two things of higher yields, of lack of competitors, although now a lot of people have rushed into private credit, so there's more competition. And then you couple that uh, with debt, you're in a lower risk position in what we call the capital stack. So going back to, like, your mortgage, if you don't pay your mortgage, the house takes, or the bank takes your house, right? And the bank takes your equity with that. So you might have 20% down, but the bank now owns the entirety of your house. And your equity is essentially their buffer. It's their cushion. Um, Works the same way with private credit funds. We lend our money to investors. Those investors have their own skin in the game, their own equity that they're bringing. And if they don't pay their bill, their interest, then we can foreclose on their properties. So that's the macro stuff. Now, like, why is it interesting to folks like yourself? One, like I said, high yield. So right now, like the Spectra fund that Bradley's in, we're distributing at 14, 15, 16%, depending on the share class of the individual. Um, it's it's not tax advantaged, which I'd say is a downside. So, um, it's just your typical interest income. And for folks like yourself and a lot of my investors who are in a very high tax bracket, usually in high tax states, um, a lot of that interest that they're going to receive is heavily taxed, right? But I do have a number of investors that value diversification pretty heavily. So a lot of my folks come from Amazon. They have a ton of Amazon stock. If they don't have it all in Amazon stock, they have a lot in index funds, which are pretty top heavy to tech stocks, and they're looking to diversify into other things that don't correlate. So that's typically what brings them into real estate. But then within real estate, you can diversify into a bunch of other things, right? So you can diversify into multifamily, and then you can diversify into being the lender or being the bank. So that's another, diversification has been pretty big with investors too.
Thanks for that, TJ. I'm curious too. So you hear this term hard money loans, right? Like, what is the
Yeah.
comparison between the two, and why is it more, or is it the same thing, or how does talk to me about that?
Yeah, so hard money loans, that means that you're lending based upon the asset value. So, like, solely the asset, has nothing to do with the borrower. And that's why you might hear about somebody that's doing their first flip. Let's say they go out, they find a fantastic deal. Maybe they're paying 100 grand for something that's going to appraise for 300. They got to put like 70, $80,000 into it. Um, but they're able to go get a loan from a local hard money lender despite having no experience, because that hard money lender is just valuing the deal based upon that asset. And that's why it's called hard money lending, because the hard asset that they're basing, their financing on. So with the stuff that I do, that's a component of it. So both private credit funds that we're offering, the fund underwrites the asset pretty heavily, of course, but they also underwrite the borrower. So, for instance, in underwriting the borrower, you might be getting personal guarantees on the loan, which means that, if they don't pay the loan, then their other assets are at risk. We're underwriting their credit worthiness. So credit score, also their experience in doing whatever they're trying to do. Like let's say they're flipping houses. We might look and say, well, they flipped 10 houses in the same market. That's a plus. Like we want to see that. So it's a hybrid. And you can do both. I think it's a little bit more conservative to look at both the borrower and the asset. So we call them more like special, like small business loans, or like, yeah, it's kind of similar though to hard money.
Got it. And I'm curious, so are you underwriting? Like Burns Capital is doing that, vetting, looking at the financials or the W-2 or whatever, they're
Right. Yeah. So no, my
okay.
involvement with the lending funds, and this is kind of one of the core, the core thesis of my business is, um, I'd rather go and find the people that are very, very good at X. So in this case, at underwriting, and go and vet their operation as opposed to trying to build it myself. That might change at some point, but that's why I've gotten involved with groups like Spectra, which is their own company and they handle underwriting. And my extent to their, I'm not really involved in their day-to-day operations, but I speak with them more on a high level. We'll talk every few weeks and discuss how the fund's doing as a whole and what the different developments are.
Okay. Last question that I want to open it up to the rest of the group. So you talked about the risk, right? And gave
Yeah.
the analogy of the bank being able to foreclose. They get that equity that you had in the home. Like, what are some of your lessons learned on the risk side of doing these deals? I see that, like traditionally, if you can make 10% in the stock market, there might be 4 to 6% upside. You're still getting taxed, but could be more risk. I don't know. But talk to me about what you've learned and how you're using that on where you're headed.
Yeah, that's honestly the most interesting part of these deals, because like everybody, you can find plenty of deals that are advertising high returns, and then you can't figure out what the risk factors are. So I try to focus on that, especially since my crowd's engineers who are, that's really all they care about. It's like, what's the risk?
Yeah.
So with lending, there's a couple of different verticals of risk. So like one would be risk in your underwriting. Like how well are you underwriting these deals? And within that, it's, do you know how much, how valuable these properties are? Can you determine how much they're worth? Because that's going to be like the cornerstone of what you base your loan upon. And if you're off in that metric, if you think like a $200,000 house is worth 400,000, then you're going to be out of business, right? So, making sure you nail that part is important. How much money you lend based upon that value is also like a very common metric. So that's called loan to value. Like let's take, $200,000 house. We're going to lend 50% loan to value. So we're going to lend 100,000, and then that other 100,000 is going to come from somewhere. If there's a difference in the value of the property today, or like I guess what we would call the project cost today. So like purchase price plus closing costs plus renovation budget. And if there's a spread between that and what the after repair value is going to be. So like basically the house flippers model, I'm going to buy the property for 100. I'm going to put 50 into it. It's going to be worth 300. We'll also look at that, and that's called loan to cost. So that metric basically just determines how much actual cash is the investor bringing. Whereas loan to value is more like, how much could we sell this property for if we had to foreclose? So those are some things to consider with underwriting. In terms of the process of lending money and loans going bad, there's what we call like foreclosure risk. So the process of foreclosing on properties is, first off, it's like state dependent. So depending on where you lend, it's different, and the process takes longer. So like if you lend in New York, foreclosure process is a lot different than if you lend in, like, let's say Arizona. And you can structure the loans like legally a certain way. So you can have like the borrower set up an entity, and you can, own part of that entity, and write legalese that says, hey, if you don't pay your bill, we can foreclose faster. But that process is a pretty big risk factor. And what people will look at when they're underwriting private credit funds is, what's the delinquency rate? Like how many loans do we expect to go into delinquency? Delinquency. And the lower that number is, generally the less risky, a fund is. So I could probably talk forever, but I don't want to just ramble.
Yeah, that's interesting stuff, man. Thank you for that.
Yeah.
If I may, Mike, what is the level of involvement with an investor? What's the process? What's the maintenance? What's the typical involvement?
Like for passive investors, you're saying, like LPs?
Yeah, if I gave you some money, what's my involvement?
Yeah, so that's one of the things with being a passive investor, is that for some people like this, some people don't, is that you don't have much control over how the deal goes. Now with a lending fund, they're a little bit more liquid. So whereas if you invested in like a multifamily deal, that investment's going to be illiquid until there's some sort of capital event, whether we refinance or we sell the property. With a lending fund, because there's a portfolio of loans that are being paid off at different times, which is creating liquidity. Usually you can withdraw your capital a little bit sooner. With the stuff I do, it's about a year lockup period, sometimes less. So you have control in that aspect, but you don't have control in terms of which loans are being made, the direct strategy. Now what I do is I pitch people on like a case by case basis. So I don't do blind funds where I say, hey, send me some money and I'm going to go invest in something good. I don't know what it is yet. I don't do that. Instead I stick to like, hey, here's our strategy here. If it's a fund, usually it's already being employed somewhere. Or hey, here's a deal that we're investing in. When you want to make an investment, I have an investor portal. It walks you through establishing yourself as an accredited investor, which is usually a requirement for what I do. Signing legal documents, so formally admitting you into the partnership through an operating agreement that you sign, subscription agreement, and and then once you make your investment, usually do monthly updates on how things are going. In the case of a lending fund, what new loans are being made, any changes that we see on the horizon, and then you just receive distributions as we have them.
I just want to quickly chime in. I wanted to let the group know in terms of like the selling points for me when it came to private credit and the Spectra fund was one thing that TJ brought up was the liquidity aspect and the fact that I can take my money out a little bit quicker than your standard syndicate. The other thing on top of that is the diversification piece. Like a majority of my investment portfolio is in stock or in the stock market. So this was an opportunity to put some additional capital or some additional money that I had just somewhere else that was making a similar return. In my opinion, in doing my due diligence, seemed pretty risk averse. And again, the liquidity aspect. So I just wanted to touch on that. The only other thing, I don't know if there's any other questions on the private credit. If there's not, TJ, I'd love maybe with the remaining 12 minutes, if you could touch on any like upcoming syndicate multifamily, whatever it may be, maybe just doing a quick like run through of why you're excited about it, so that we can kind of have two different lanes or two different types of opportunities that these guys can hear about.
Yeah. Sure. Yeah, I'll go right into it. So this one ties to my story because the fellow that I returned the wallet to ended up becoming a good friend of mine, and we've done I think 7 deals together at this point. I really lucked out, and he turns out he's a man of high integrity. I've seen him in some of the deals we've done, put his own cash in to shore things up after the fact, and has always acted true to his word. So um, one of my favorite partners to work with, and usually when he brings me a deal, if things pencil, then I like to work with them. And he hit me up about a week or two ago. So his name's Axel. He runs a company called Align Real Estate Partners, has a podcast called Multifamily Wealth Podcast, and operates in New Hampshire, owns a property management company there, owns probably about 300 units or so. And then him and I, own a couple, probably like a little bit over 100 units with partners that we raise money from. And his focus is buying small multifamily in that marketplace. Has a pretty great marketing presence where he's able to find deals that are discounted to market, usually through mom and pop sellers, and operate those deals a little bit better than your hobbyist investor because he has the infrastructure of the property management company and the data of managing another, or owning another couple hundred units. So the latest one that we're going to be working on is 72 unit over on the seacoast of New Hampshire. So if you're not familiar with New Hampshire, it's kind of like this. It's almost like a rectangle, and the west side's where Manchester is. We own some properties there. It's a little bit more like B minus class, so a little bit more on the side of like affordable housing, more transient tenants. And then as you move to the seacoast, it neighborhoods get a little bit nicer. That's where the UNH is, which is the college town. So we've kind of shifted our focus from buying these C-class deals to now trying to buy better pieces of real estate that might be a little bit more expensive. But as my business has scaled up, as his business has scaled up, we're now able to raise the money required to go and buy those buildings. So this one, I'll just rattle off some facts with it. 72 unit. We're buying it for 15 million. Probably raise about 5 million for it. IRR is going to be somewhere in the mid-teens. We're buying it with probably finance 70 to 75% with agency debt. So fixed rate debt, probably around 6.25% for the debt. And it's pretty stabilized as is, which usually we do value add deals. There's a little bit of a value add component to this. The existing owner, they do a lot of stuff like with loose leaf paper, and there's opportunities to take some of the software that we use and manage things a little bit better, maybe charge like upcharge on certain things like pets, raise rents on some of the units slightly, but overall it's just like a really good building to own. Like if we're going long real estate in New Hampshire, which the market in New Hampshire has performed really, really well, especially through like this multifamily downturn that we just went through. There's not a lot of supply in New Hampshire. There's a lot of demand, especially as people migrate from New York, Connecticut, other surrounding states to New Hampshire, where it's more business friendly. It's more like freedom centric, for lack of a better term. So the real estate has been benefiting from kind of that tailwind, and with this property, while we'll hold it, and there's some equity that we're buying with built in, so it'll probably appraise for a little bit higher than what we're paying. there's really like, the plan is to just manage it a bit better, a benefit from rental increases. And then as, as rates move, if they don't move, that's okay. We've underwritten it where they won't, but if we see a drop in rates, we're going to benefit from that massively. We're going to be able to refinance and probably, return a good amount of capital to investors.
TJ, do you have any material on some of the comparable units that you own in the area that you could maybe share with us on like the success or maybe even the lack of success, just so that we have an idea of like some of the other details of properties or units that you've run within that space?
Yeah, definitely. I might need a few days to put that together. I don't have it like formally together in like an updated fashion, but as I launch into the marketing of this new opportunity, those are things that are gonna, have to be done. So
Cool.
so yeah, give me a couple days, but I'll be able to get that to the group.
DJ, this is pure just me being inquisitive. What happens in these deals when the property gets damaged, natural disaster? Is there any financial risk to us there in the private credit deals?
Um, with private credit, we're a little bit more insulated because the borrower is gonna first have to deal with, all the different things that come up with owning real estate. So natural disasters being one of those, all these borrowers, they have insurance policies that are required for us to lend to them. Um, if and if for some reason they cannot hold on to the property and they have to be defaulted on, then at that point, that's when the fund would, you know, get involved in the foreclosure process and foreclose on the property. And that's when the loan to value metric, becomes very important, because if you're making a loan on a property at 50% loan to value, you expect there to be a pretty significant buffer to, protect investor equity. With the multifamily deals, it's a little bit more, not a little bit, it's a lot more impactful, right? Like, so for instance, Axel and I, we own a 48 unit down in outside of Tampa that we bought 2.5 years ago. And it's like right in the hurricane path of, every hurricane that comes through. Um, so what's happened there is our insurance coverage has tripled. I'm not sure if you guys have probably seen what's happened in the insurance market. Starting to come back down now, but the amount of natural disasters is reflective upon our premium, right? So insurance goes up, our cash flows go down because now our expenses have gone up, and then we can maybe change policies, but then we might have a higher deductible. But we're always taking out insurance on these properties, of course. As far as the investor go, the one of the benefits of being an LP is that your liability is limited. So, you're not really on the hook for the debt that we're taking out. I say not really. You're not at all on the hook for the debt we're taking out. If there's any kind of lawsuits, the LP is insulated from that. It's probably one of the reasons why family offices like this type of investment. So, family offices will write big checks as LPs into various deals. And with New Hampshire is a little bit less susceptible to natural disasters, things like tornadoes, hurricanes, earthquakes. Um, doesn't happen as much up there. It's another reason we like it.
Thank you. That was helpful.
What's the average investment size for private credit from individual to
Yeah,
group?
yeah, it's kind of across the board. So the Spectra fund, the minimum is 50,000. I just launched a different private credit fund, which has similar returns, but kind of a little bit different strategy. That one minimum is 25,000. Multifamily deals minimum is usually 50,000. On that note, I'd say that because this type of investing adds a little bit of complexity to your taxes, like you get another tax form called the Schedule K1. You have to factor that into doing your taxes, and sometimes it adds a little bit of cost, a couple $100 or something. I usually tell people, like, if you're just looking to invest 25,000 into a private placement and that's it, then maybe it's not worth it. But if you're just looking to dip your toe in, invest the minimum, see how it goes, I think that's very worth it. And I have a lot of investors that do that. In terms of average check size, I'd probably say average is like it's between 75 and 100,000. Most with the median check size being probably 50,000, although it's now starting to trend towards 100,000. Like, as some of my investors get more comfortable with me, they've been in deals with me for a few years. And I have a couple investors that have invested, a couple 100,000 per offering, anywhere from 250 to 500,000.
Cool. Thank you.
What sort of stuff are you guys investing in now? I imagine probably a huge emphasis on stock market, which most people, that's where they invest. Are you guys investing in any kind of private offerings at this point, or are you guys investing in direct real estate? Like, I'd love to hear more about that.
Yeah, I'll take a stab at it. My family and I have been, as DeGarmo and some of the other people who went to U of A, started with one student rental in Tucson, and now we're up to about a dozen properties, both in Tucson as well as in the broader Bay Area. And we tend to focus, our mission statement is really geared around students. The influx, the ever-growing student base, plus being offset by their parents, seems to be fairly safe. Then again, depending on which house they're in, comes the risk of damage and whatnot. But it's interesting. We use a property manager for some houses, others I manage directly. But I was saying before you jumped on, it's so crucial having a trusted person in that local market. But we're doing purely direct, and pretty much all cash. We very rarely take out any loans to finance them. We like the cash positive nature of that. But very interested in the credit side that you were discussing.
Yeah, a couple of the group members are in Airbnbs and short-term rentals, long-term, Arizona, California. I own, a house myself, but this avenue is interesting, because of the fact of what Mr. Nozel said, is that I don't know if I have the bandwidth to manage any properties, right? So that's the challenge for me, is like, I don't know. I want to be in real estate. I want to be in more real estate, but I don't want the burden of having to manage it.
Yeah, and I have that conversation all the time with people who are in these tech jobs, and they work a ton, and they understand that real estate is a great place to diversify into. But they just don't have the bandwidth to go and invest, or at the very least to go and buy a good deal. Like they say, I can buy the property, down the street from me in Seattle, but it doesn't cash flow, and I'd have to put down a ton of money to make it cash flow. So with that said, like, I meet some people that are they love real estate and they have the time and they want to go be an active investor and build a business around that. And what I tell them is, that's fantastic. I think you should go do that, because when you do that, you're not going to split the upside with anybody. If you want to be the person making the decisions, you're going to have full control. And if you don't mind taking the risk associated with whatever your strategy. Now, if you're buying all cash, there's less risk, of course, but there's always risk of liability as well.
Yeah. Yeah, no, this is awesome stuff, man. And I would love for you to get us some of these upcoming deals and really look at the numbers. I mean, that New Hampshire one sounds interesting because, to your point, you don't have to add value, you don't have to do renovations, and it still cash flows, right? There's upside with the interest rates and where that might be shifting, as well as on the private credit side. Like, I'd love to see some deals if you're open to sending it to the group. And let's keep in touch, man. Like, maybe we have you back and you walk through a deal in depth as a next step. once
Yeah.
you get it, that could be kind of our next move, man. But just the story in general, the wallet guy, I mean, what a full circle moment, dude. That is so cool. And congratulations on making the move, man. I mean, I love the way you did it. Is you kind of had, you built it up, and then timing was right, and you went after it, man. So congratulations, and I'm loving that we're connected.
I
Yeah.
appreciate it. Yeah, I'm loving it too, and I really appreciate you guys welcoming me into your group, and would love to come back and go through underwriting on the deal. Probably that 72 unit.
Yeah,
If you want to do it in the next few weeks, once I kind of get all the materials together, I'll go through the underwriting, kind of what to watch out for in underwriting, because those things, like, you can apply them to any type of private placement you're looking at in multifamily. And the risk factors are similar, like on things to watch out for. And these are all things that I've learned over the last dozen or so investments, like mistakes that I've made in
Yeah.
evaluating deals where I put my own cash at risk, and sometimes it worked out and then other times didn't, or at least it's still playing out. And so yeah, would love to, is a short answer.
absolutely, man. And I'm gonna send out this recording to the group. But dude, so appreciative of your time, man. And again, thank you for joining. And Bradley, thanks for the connection, man. I'm excited to see where this thing goes. But
Yeah.
TJ, man, we'll be in touch for sure. And I'll shoot this out, like I said, and let's just keep in touch, man.
Perfect. All right. Thank you, everybody.
You guys all
Thanks,
have a good
TJ.
night. Good catching up, guys.
Bye,
Thank
guys.
you guys. Thanks, TJ.
CJ. Bye.
See y'all.